Russian stocks no longer trade on world exchanges. Russia has been deleted from major world index providers like MSCI. Russian ETFs, they no longer trade here in the U.S. or here at the NYSE. But for the fallout for the mutual fund industry and the ETF community may be a lot wider than just those who had money invested in Russia. Let's talk to Dave Matza. He's the head of product at Direxion. Ben Johnson is director of global ETF research at Morningstar. And James Davalos is portfolio manager and research analyst at Horizon Kinetics. Dave, you manage the Direxion Russia Bull 2x shares ETF. That's a mouthful, but it provides 2 times the exposure to a market cap weighted index of Russian companies. Well, I talked to you last week. You were going to halt trading on March 11th, but the NYSE did it for you. They halted trading of your fund and 2 others on Fridays. Tell us a little bit about how you and the ETF industry are reacting to what is essentially the forced closure of that fund.
Yeah, exactly. If we take a step back, we have 2 concurring forces that are happening at the same time. On one hand, we know that local equity markets in Russia are unable to be transacted in. They've been closed now for some time. So the actual ability to price the security that's not trading is very difficult. So even though the weights in many larger emerging market ETFs and indices for Russia are small, Russian-specific ETFs, of course, are going to be larger. So in those cases, the NYSE, as an exchange, made the decision to actually halt the trading of those particular securities because their prices were so disconnected from the potential price of a Russian security. Who can say what a particular company should be valued at if you can't trade and an investor can't transact?
Yeah, you know, Ben, it seems like, and I was talking to Dave about this, and you too, it seems like we're seeing the retreat of globalization played out in the investment space. I know Russia's a very special situation. We have a war situation, but we've talked about this for a long time, you and I. There are broader concerns about global investing. What about other regimes that are not at war, but we do not approve of, like China? You and I have talked about this in the past. Are parts of the world starting to become uninvestable?
Well, Bob, what comes next is anybody's guess. And in the meantime, what you see is that the index manufacturers are really playing by the rules. What you see outlined in certain chapters of their rule books is exactly what's being executed right now. When the underlying markets are closed, all bets are off on these securities, not just in Moscow, but in London and New York. They can't get a good price. And index providers depend on having good prices. The asset managers that are trying to track those indexes certainly don't want to track an index that doesn't have prices for its underlying constituents. So the indexes are playing by the rules. The asset managers are trying to play by the rules. Some of these rules specifically that are unique to the asset managers, to whether or not they can transact, they can't, and they can't dispose of any securities that they can't actually make an economic transaction in. So we're going to be making some things up as we go, and we're really in uncharted waters here right now.
Yeah, I certainly agree that the index providers are playing by the rules, but I'm interested in the broader philosophical implications of what we've been discussing, not just with Russia, but even with China and other areas of the world. So Dave, some have argued that China's autocratic actions should be sufficient to convince some investors that China itself isn't investable any longer. U.S. Senator Marco Rubio, we have had him on many times. He's led calls to convince pension funds, particularly government pension funds, to sell their China stocks. While index providers have declined to delete China from the global indexes, it's not the same thing as Russia. They've made it clear that if there was demand for an index of global stocks that excluded China, it could be easily provided at this point. So you get my point here. We're debating very broad issues about inclusion and investability at this point that we were never debating 2 or 3 years ago.
Yeah, no, that's absolutely right. And I think individuals right now, of course, need to make a decision either by themselves or with an advisor to say if a particular country or security is right for their portfolio. But if you even take a step back from that, we had been in an environment where for years we were being told to diversify away from the U.S., away particularly from the U.S. FANG stocks and the mega cap growth that have dominated indices. And the area people have been going to is emerging markets because they've been so out of favor and so inexpensively valued relative to their history. And that's all really changed. So I think what you're seeing here is that the door is potentially open for index providers to take greater action than many people had assumed. To Ben's point, much of this is laid out in rule books, in guidelines, things of that nature. But most people don't expect, of course, to wake up and find a war situation. But the question I would have, and I would advocate investors large and small to think about, is what actually is the potential playbook and path forward? This is not to say that we're going to see a particular action that China may take or not. It's just simply, if that occurs, I think we know that index providers aren't going to wait around anymore to necessarily be told what to do, and they might be moving faster than asset managers.
Yeah. So, Ben, what about that playbook? Is it different? You know, he's right. For years, we were told we should diversify. We talked about how to lay it out. Now we're told sort of maybe not diversify. What will the new global investment order look like? The old order you and I grew up with, simply investing globally by market capitalization, it may not have resonance for a lot of investors anymore, even if they just remain in index funds.
Well, in light of certain current circumstances, Bob, I think it might not resonate in the case of broadly diversified market cap weighted exposures to emerging markets, where you see China really looming large and larger than ever, in fact. And the direction of travel in recent years is to include more exposure to China by way of, for the first time, onboarding exposure to onshore listings of Chinese equities. I think this is a moment that's going to give many investors pause. We've already seen index providers respond by offering emerging markets ex-China benchmarks. There's countless different benchmarks out there. There's funds now that track them. And there's some clever ways beyond just broad-based market cap weighted that you see index providers and ETF providers bring exposures to bear to investors that invest in emerging markets, but keep a close eye on some of the issues that we're living through in this very moment. And I can mention tickers like FRDM, a freedom-weighted index that has not had exposure to either China or Russia. You look at another fund like Wisdom Tree's XSOE. Now that's got exposure to some of these markets, but specifically looks to remove state-owned enterprises from the mix. So there's no sort of limit to the creativity, the dynamism, the options that index manufacturers and fund sponsors have to try to navigate some of these issues.
Yeah, Perth Toll at the FRDM is a friend of ours, a friend of ETF Edge. Ben, try to explain something to people who don't quite understand how these ETFs work, what these funds are going to do with these Russian stocks. You know, the Telegraph in London has reported that investors have £1 billion trapped in the Russian stock market. It's amazing that the index providers like MSCI have simply decided the value of these Russian assets are now zero. They made zero. So with a fund like, I don't know, iShares Emerging Market ETF, the EEM, that's indexed to MSCI's Emerging Market Index. It has roughly a 3% weighting to Russia. They now have a bunch of stocks, iShares Emerging Market ETF, that have a zero value all of a sudden. Can these ETFs sell their holdings if and when the Russian market reopens? How does this work?
Well, there are a variety of things that have to happen first, Bob. For the time being, all they can really do is sit on their hands and keep up to speed on developments as things continue to change on the ground. So until the Russian exchange or the listings of any of the ADRs or GDRs begin trading hands again, they simply can't do anything. They've marked down, in many cases, the value of these positions to zero. They continue to sit in the portfolio. The owners of these funds will have a claim on those underlying securities in the event that they become liquid, that they become tradable again. There could be a bit of a pop. Certainly, you would expect a pop beyond a value of zero. And at that point in time, those securities are going to be liquidated from these index portfolios because they're no longer in the index. So you'll see a little bit of a blip in terms of positive tracking error. Investors will get out of those securities, and in all likelihood, Russian stocks will be in the penalty box for the foreseeable future, off on their own, until the index providers can get comfortable mainlining them again, if that ever happens.